All right, let's get started. Good morning, everybody, and very welcome. For those of you who don't know me, my name is Michael Culligan. I lead Milliman's practice here in Dublin, and I'm delighted to welcome you all here this morning to our, I suppose, back-to-school breakfast briefing. We've two very interesting speakers this morning. Eamon Comerford is going to speak about IFRS 17, and Lisa Henderson will speak about InsurTech. I'll introduce them both properly a little later on, but first of all, I'm going to spend just a few minutes doing a quick roundup of regulatory developments and other topics of general interest. As usual, we'll try to leave some time for some questions at the end. We'll take questions at the end if that's okay, and we'll aim to get you out of here by 9 o'clock as usual. So just with the usual instructions about mobile phones and fire exits and all that sort of stuff, I'll get started. So the first thing I wanted to cover was recent CBI activity. It's fair to say the CBI has been busy in recent months and has given me plenty of good material to work with. Firstly, enforcement has been, I guess, quite high profile recently with an enforcement action and a substantial fine levied on an insurer for failure to comply with Solvency II requirements. And I suppose without getting into the details, the key messages for me, the key takeaways, if you will, were, first of all, the value of getting external validation and advice in terms of your Solvency II compliance, which is coincidentally an area in which we specialise, as well as the importance of good governance and good governance processes. I think those were the two key messages for me. And whilst this was the first enforcement action, and the CBI was quite prominent in making clear this was the first enforcement action under Solvency II, I have a feeling it won't be their last. Another very topical publication, certainly for life insurers at least, or for some life insurers, I guess, was the CBI's recent letter setting out the findings of its review of performance fees on UCITS. So although focused on UCITS compliance, I suppose it is important to say that, and therefore not technically directly relevant to insurers who might be running internal linked funds, I think there are still some very clear messages and lessons that shouldn't be lost on insurers with funds that levy performance fees. So I really would encourage insurers with those sort of funds to take a good look at it. I think it is very, very relevant, even if not technically applicable. Moving on then, conduct risk, or I guess more accurately, conduct regulation, continues to be a key focus for the CBI. Recent interviews and speeches from the senior personnel there have reiterated the importance that the central bank is placing on conduct risk and conduct regulation. Now, admittedly, a lot of the focus to date has been on the behaviour of the banks, but it's also clear, I think, that the CBI's attention is shifting, and they're taking some of those lessons and approaches and moving them now into other sectors, including insurance. So I definitely think it's one to watch. And of course, they already have the CPRA regime in place, which, again, just to reiterate, is not just a domestic issue. It also applies to cross-border firms, and they will, as they have said, be checking for compliance on an ongoing basis against that standard. So certainly one to keep an eye on. I think another very interesting development, and maybe a slightly disconcerting one for many people in the room, including myself, who are PCFs, is the CBI's recommendation that Ireland should introduce what they're terming a senior executive accountability regime, or SEER, building on the existing PCF regime. Now, I guess it's still unclear as to exactly what that's going to look like, but I think it's something that firms and PCFs in particular are going to need to keep a close eye on in the coming months. The UK has already gone down this road, and so might provide something of a blueprint. It's probably fair to assume. But if you want to find out more about that, I can point you to a recent briefing note that we have published on this, which you can find on our website or indeed on our Milliman Ireland LinkedIn page. I won't say too much about diversity or culture because for those of you who were here at our previous breakfast briefing in June, you'll know that Sylvia Cronin said a lot on those two topics at that briefing. And you can find her speech on the Central Bank website. It's a very good read if you missed the briefing, or indeed if you just want to catch up on it. Really, I guess all that remains to be said on it, or all I'll say for now, is that these are clearly very high priority and high profile topics on the CBI's agenda, and I think need to be recognised as such. Briefly then, in terms of kind of looking maybe a little further, a little forward, a little down the road, and maybe looking a little further afield, it's clearly worth keeping an eye on what the CBI and others will be up to in the months to come. So what will the CBI's priorities be for 2019? I think it'll really be more of the same. I think there's the sort of issues that we talked about, or that I talked about a moment ago on the previous slide, things like the senior executive accountability regime coming in. But I think it'll be a continued focus on examining firms and holding firms accountable in terms of things like governance, in terms of conduct risk in particular. So while they haven't, at least not that I'm aware of, published an explicit list of priorities for 2019, I think it's fair to assume that it'll be those sort of things that will be keeping them occupied. At European level, EIOPA has already provided its views to the European Commission on potential changes and updates to the standard formula under Solvency II. And these are with the European Commission for review and for implementation. Beyond that, which is imminent, beyond that, looking slightly further afield, there are further Solvency II reviews scheduled for the next couple of years, including particularly the elements of Solvency II around long-term guarantees. But beyond Solvency II, there's lots more going on at EIOPA level. And as ever, looking at what's happening at EIOPA level gives us clues as to what's coming down the tracks locally. So really, there's an awful lot going on there, everything from consultations on national insurance guarantee schemes to pan-European personal pensions and really all sorts of things in between. So a lot to keep an eye on there. And finally, just very briefly, it's probably more of a minority pursuit, to be fair. The International Association of Insurance Supervisors has recently updated its draft insurance capital standards. Now, these have been sort of long awaited, long delayed. They're making slow progress with them. But they will eventually, I guess, be applicable more widely, and they'll need to coexist in Europe with Solvency II. So there's still some way to go on this front, but it is worth keeping an eye on because it will gradually be rolled out and will gradually be applicable to more and more people over time. So one to keep an eye on. Okay, I guess enough about regulation. I was going to move on to just take a quick look at the state of the Irish industry. And the Central Bank recently published some aggregate data on the industry for 2017. I thought it might be interesting to just share a few key figures. So we've got 197 companies, nearly 360 billion in assets, nearly 300 billion in technical provisions, firms having a combined 39 billion of available capital covering an SCR requirement of 22 billion. So that's an aggregate solvency ratio of 176%, which is very interesting. It is very useful information about the industry as a whole. But I guess what you'd miss, or what I miss anyway, maybe because I'm a sort of a nerd when it comes to this stuff, is the old blue book, which gave you the company by company, line by line analysis of how each individual firm was getting on. And you don't get that anymore. You just get this sort of high-level information published now by the Central Bank. So in order to get that sort of information, you now have to go digging through individual companies' SFCRs. We're in the process of doing that at the moment, and we will be publishing a report later this year with, I think, lots of interesting information and snippets and nuggets about the Irish insurance industry as you dig below the headline figures. And just sort of as a kind of maybe a preview of that, or just a kind of a little look at individual companies, I thought today I might just very briefly focus on one thing, which is the capital requirement, or the SCR, and specifically to look at the top 10 companies in the industry here in Ireland ranked by SCR. Now, I chose SCR, the solvency capital requirement, the regulatory capital requirement, as a measure to use because it's a measure that kind of, I think, allows you, it's common to all companies, whether you're life, non-life, or reinsurance. And it also takes account of not just being a volume measure, but it's also reflecting the nature and the scale of the risks that are in the business because it is a risk-based capital measure. So on that basis, the top 10 looks like this. And I thought it was an interesting list, and maybe a list that you sort of don't see if you take a different perspective on the industry here. And I guess a few things struck me as I was pulling it together. I suppose, first of all, the sheer scale and size of some of the companies when measured by SCR is pretty enormous. You get Zurich Insurance there with nearly 2 billion capital requirement. But I guess the other thing that struck me was that there's, first of all, I guess, a preponderance of reinsurance companies on the list. And also, I guess the list is dominated by life. There's very few, other than Zurich really, there's very few what you would call no other non-life players really, other than a couple of composite reinsurers who have life and non-life business. I guess that sort of reflects the fact that the life companies tend to have bigger balance sheets and therefore maybe have more market risk as a result, and that maybe inflates the numbers for them somewhat. But nevertheless, I thought it was an interesting snapshot. The other thing is that the 10 billion, even though these 10 companies, because we've got about 200 companies here in Ireland, they only account for 5% of the market measured by number of companies. They actually account for close on 50% of the market if you measure by the total SCR. So it's about 22 billion total SCR for the industry here as a whole. And these companies have nearly 11 billion of that. So it is a very, very concentrated market when you look at it that way. I guess the other thing that struck me is that perhaps a little bit surprising that so few of these companies have internal models. That was kind of an initial reaction, but then I suppose thinking about it a little bit further, I suppose some of the life companies are relatively straightforward and relatively plain vanilla in terms of their risks, so maybe an internal model isn't really going to do much for you. But that is something we're looking at with some companies in terms of, do internal models make sense? It's a big investment, there's an ongoing cost, but if you've got a substantial SCR, perhaps the costs, the benefits outweigh the costs. And we're also looking at other things that you can do, even if you don't go down the internal model route, in terms of managing your capital requirements under Solvency II. So whether that's different use of reinsurance, whether it's asset liability matching or management, unit shorting for unit-linked companies, there's a range of tools that can be used to manage the capital requirement. So yeah, that's just a brief teaser, I suppose, of some of the information we might be giving out in the report later this year in terms of looking at the industry here. So moving on to look at then hot topics and developments in the market, I'll just very briefly skate across the surface of a few things here before we hand over to our next speaker. But Brexit and M&A, I guess, again, for those of you who were here last time in June, got quite a mention. Dermot Corrie did a kind of very interesting piece around what's going on in Brexit in Ireland and what's going on the M&A front, focusing on the consolidators and the private equity money that's been flowing in. And I think really the message is it's going to be more of the same really in the intervening few months between then and now. We've seen AXA Life Europe acquired by Cinven, so continuing the theme and the story of private equity money coming in and looking for particularly closed books of business, but maybe not just closed books of business. I suppose on that theme, we've seen Phoenix complete its acquisition of Standard Life, Phoenix being known traditionally as a closed book consolidator, but now moving into open to new business territory with Standard Life. So that's another big development. And then I suppose companies like Standard Life, like Prudential and so on and so forth, have been starting to get some column inches as well as the media have picked up on their Brexit plans, which involve kind of very substantial increases to their footprint here in Dublin. Pensions, especially for the domestic market, is a big issue at the moment with the publication of the straw man for auto-enrollment. I suppose just about a month or so ago that was published, and it sets out a vision for what an auto-enrollment pension scheme might look like in Ireland. And clearly that brings potential opportunities for some players in the market, but also potentially some threats, and it'll be interesting to see how that develops, in particular, I think, around tax relief. And this is an area that we've done a lot of work on in the past, and we'll continue to work with industry to help them make their case around some of the issues that need to be considered in any transition or any new developments on the pensions front. And of course, even if you're not a life insurer that's active in the domestic market, an auto-enrollment pension scheme is going to affect everybody in this room, every employer in this room, in the sense that as Irish employers, to the extent that you don't have pension schemes, although I guess most of you do, you'll be down the auto-enrollment route potentially in the near future. Briefly on non-life, I mean, it's been, again, more of the same. We've seen kind of publications of the analysis of motor claims from 2011 to 2016, which is a very useful, interesting piece of work. We've seen the continued work of the Cost of Insurance Working Group. I guess familiar themes from the central bank's perspective, again, around kind of reserve adequacy and reserve reviews, and that continues to be a focus of theirs, and also looking very closely at the underwriting side of things, and recently looking at the opinions that the heads of actuarial functions have been producing around underwriting opinions, and I understand that there may well be further guidance to come on that from the central bank following that review, based on the good practices and maybe the not so good practices that they've seen as they've surveyed the market on that. So that's a very quick run through kind of what's topical at the moment. Two other topics that are very topical also, IFRS 17 and technology. I wasn't going to say anything about those because I'm going to hand over now in a moment to our next couple of speakers who are going to talk about those. First of all, we're going to have Eamon Comerford. Eamon is consulting actuary here in Dublin, and he has a wealth of experience across M&A, Solvency II, and PPI business in particular. But currently he's working on a number of IFRS 17 projects, and he's going to give us an update on what's happening on the IFRS 17 front. And then Eamon will hand over to Lisa Henderson, who will talk to us about all things InsurTech. Lisa joined Milliman just a year ago and is championing and spearheading our InsurTech efforts. She has a history in the technology field, having developed and sold technology businesses in the past, and was previously also an Ernst & Young Entrepreneur of the Year. So with that, I'll hand over to Eamon to talk IFRS 17, and hope you enjoy the rest of the morning. Thank you.
Hey, thanks, Michael, and good morning, everyone. So over the next 20 minutes or so, I'm going to talk about four kind of main areas. Firstly, just a brief reminder on the timeline for IFRS 17. Next, then, I'll talk about the latest developments that we've seen on IFRS 17 over the last number of months. Thirdly, I'll focus on some of the case study results that were produced by EFRAG over the summer. And lastly, then, I'll just touch on some of the key implementation challenges we're seeing from companies at the moment. So hopefully, most people are reasonably familiar with the timeline at this stage. So obviously, the key date is 1st of January 2021, when IFRS 17 becomes effective. But I suppose before then, you'll need to have done prior year numbers based on 2021. So I suppose in effect you kind of need to be reasonably ready by the end of 2019 in order to do so. And of course, on the asset side of your balance sheet, then you'll also have IFRS 9 coming in. So presuming you're using the delay approach, which most companies are, then that will also be coming in 2021 as well. So we've seen a big ramp up in IFRS 17 project activity over the last year, and particularly in 2018, and especially even since the end of the year-end cycle around the end of May. So a lot of companies at this stage have done things like training, project scoping and planning, gap analysis, initial impact assessment, all that kind of stuff. With some companies then going a bit further, and they've looked into development of methodology and maybe their impact on systems and what systems developments they need to put through. So I suppose we kind of expect that by the end of this year, most companies will at least have explored those areas and have some sort of initial thoughts on them. In 2019, then, we expect to see a bit more on the development and modelling, and probably a lot of the key decisions around methodology and what systems to use and so on will all be made sort of earlier part, and I guess into the later part of 2019 as well. So for most companies, then, I think most people will, in 2020, just be kind of into sort of the testing and automation phase, developing all the disclosures that they'll need to produce for IFRS 17. And I think in a lot of cases, hopefully doing some dry runs just to ensure there's a smooth transition when they get into 2021. So moving on to some of the latest developments then, and firstly on the IASB themselves, so the standard setting body. So there was a board meeting that they held in June, and they discussed various amendments to the IFRS 17 standard. So there were two different papers on that. So one had a whole series of sort of minor wording clarifications, and then the second one was on a particular clarification on coverage units for contracts that use the variable fee approach. So basically the new wording will say that instead of it just being based on the coverage units just being based on insurance services, it'll also be insurance and investment services. So I'm going to come back to that again on the next slide. But I suppose the main point is that the these changes were agreed by the IASB board. They don't come immediately into effect. They go through, the IASB has an annual improvement cycle for all of their IFRSs, so they'll come in at some point next year. So the Transition Resources Group then, so that's a public forum for stakeholders. So members of this group are industry participants, or representatives of the insurance industry, I should say. So they meet members of the IASB as part of this group to discuss various sort of issues around implementation. So there are 4 meetings scheduled for this year, 2 of which have happened already, one in February, one in May. And the next meeting is in September, so towards the end of this month, with a further one in December. So for the September meeting, the agenda papers are already there. So those are the ones just on the slides. So they're talking about a few different things, like the top-down approach on discount rates, some issues around insurance, and around contract boundaries, and a few other bits. The previous meeting on the 2nd of May, so I'm not going to go into too much detail on that, but there is a nice 2-pager in the pack that you've got today that does kind of a nice summary that our colleagues have done on, I suppose, the various different things that were discussed as part of that meeting. But one I did want to touch on, and it's related to what I was talking about on the previous slides around the change to the definition of coverage units for the variable fee approach. So a lot of participants on the TRG felt that while that was great for the VFA, but they felt kind of more wording changes were needed on the general model. So you could have, say, particular contracts that might have some elements of investment and some elements of insurance, but they might not meet, say, the criteria for applying the variable fee approach. So for those, you'd be using the general model, but at the moment the wording says that you should basically run off the CSM in line with insurance service. So there's no sort of allowance at the moment for investment service provided on those contracts. So that in most cases that's not a problem, but I suppose there are just some particular products where that could lead to quite a strange pattern of profits emerging. So I guess there's likely to be more discussion on that point over the next few months. So at a European level, so EFRAG is the body that I suppose they have kind of a thought leadership role, and they kind of promote and develop European views while also engaging sort of European stakeholders. Ultimately, EFRAG will be providing advice to the European Commission on whether the European Commission should endorse IFRS 17. So that advice has been asked for by the end of 2018. So I guess they're currently in the process of drafting that, and a lot of their draft documents for their meetings, are ultimately going to feed into that final advice document. So there was a board meeting just last week, and it was quite an interesting one. So the key outcome really was that they agreed a final letter to send to the IASB. And there's not a huge amount of detail in the letter, but it highlights 6 particular areas where they feel that the IASB needs to consider in a bit more detail. So there's not really much more they've asked for. They haven't asked for a delay or anything like that, but I guess it's over to the IASB to respond on these. So it's really where they feel that in these particular areas there's just not enough clarity on some of the requirements, particularly sort of in particular sort of areas on these. Then there were various other board papers that were discussed at the same meeting, and really sort of on different aspects of or the effect that IFRS 17 will have on different areas. So that's including on the insurance markets, on financial stability, on investment, and on costs and benefits. And I guess it might be surprising considering the letter from the previous slide, but actually the papers were broadly positive really overall on IFRS 17. And they more or less concluded in most of these areas that the impact would be relatively minor. Although it is worth saying that they didn't come to a firm conclusion at this stage on the whole area of costs versus benefits. So that's still to be completed over the next while. And they pointed out just a couple of statistics, but one that I just picked out was that 93% of industry respondents to a particular survey had thought that the benefits of IFRS 17 outweigh the costs. So I might just do a very quick poll here. So if you could raise your hands if you agree that you think the benefits of IFRS 17 will outweigh the costs. Okay, that was even worse than I thought. Okay, so obviously you didn't take part in this particular study. But okay, so the technical expert group. So that this is a sub body, I guess, within EFRAG. So and really their job is to provide expert advice on financial reporting matters to EFRAG, as you probably guessed from the name. And so one of the things, so they had a meeting in July, and they produced various papers for this, and two of those were case studies that they'd done on the industry, effectively surveys really. So one had 49 participants and one had 11, so they kind of summarised the results. So what I've done over the next 5 or 6 slides is to kind of pull out what I thought were some of the key findings in those surveys. So firstly, and I guess this would have been as of maybe around the end of May this year when people would have been submitting this detail, but as of that point, so over 50% of those sampled were already past the initial analysis stage. So 50% if you add the two top bars together, with the remainder then still working on their impact analysis assessment. So I suppose what that shows is that if you kind of were to wind that on a few months, so I guess the vast majority of companies at this stage are probably getting into implementation or already sort of in the implementation phase. So I suppose if you're not kind of through that initial impact analysis assessment, then you're probably a little bit behind where most people are at this stage. So they also asked some questions then around what people thought would be the impact on various types of products that are offered, and I suppose the views were kind of quite mixed on this. Almost 50-50 thought that there'd be no change, and others thought that there would be. So they put in at sort of various points that people had mentioned in this area, and I guess things like, you know, maybe some contractual conditions were changing, or particular products were maybe less attractive for insurers to sell going forward. They also asked questions on pricing, and I suppose while 1 in 4 maybe didn't or thought that pricing methodology would change under IFRS 17, I guess there's almost half of the participants weren't really sure. So I guess probably a bit of an unknown for people still. I guess what's one thing that is interesting though is that, you know, I guess EFRAG kind of took these numbers, and I suppose they would have collected other information from industry as well, and I suppose they more or less concluded there wouldn't be a huge impact on the insurance market. So a couple of slides then on costs. So the participants kind of this is again in the bigger study that they gave a breakdown of what they expected their total implementation costs to be spread across. So there's quite a bit to be spent in their view on systems and actuarial calculations. Relatively little needed on actually understanding IFRS 17 itself, which I guess maybe is fair enough. So there's sort of two graphs overlaid on each other here. So the red one is where companies have gone for just a minimum upgrade approach. So they're basically just bringing in the IFRS requirements and leaving it at that. So that was about half of the responses sort of indicated that that's what the approach they were going with. Whereas the other half were looking at a more substantial upgrade. So they're kind of taking the opportunity to maybe bring in some wider efficiencies while they had the opportunity to sort of build new systems and so on. So it's probably something to consider if you haven't already done so. So this one, I think it gives a slightly more granular breakdown, which is why I included it. It does come from the smaller case study, so the extensive one, which is only 11 participants, so a small enough sample size. So again, it shows quite a lot sort of the budget needed for actuarial calculations and systems being the main ones. Also a fair amount needed on external advice, which obviously is money very well spent. There's also, I suppose, quite a big chunk in both of the charts of other costs, which there's not really much insight into those, unfortunately. They don't seem to know what companies have sort of reported in there. There were also, I haven't put them up on the slides, but there are also a few questions then around ongoing costs of IFRS 17. So probably unsurprisingly, none of the 49 or 11 participants seem to think that costs would be decreased on an ongoing basis under IFRS 17. So they kind of cited various reasons why costs would be increased. I suppose there were lots of different ones, but the main kind of ones that came up quite a lot were the complexity of the actuarial calculations, the new calculations such as risk adjustment, and the whole area around tracking the CSM over time and the sort of data storage and data warehousing that needs to go into that. And also there's more disclosure requirements under IFRS 17, so that obviously increases costs as well. On profitability, so again, this is based on the sample of 11, so a reasonably small sample size, but still interesting, I guess, nonetheless. So what those companies overall were seeing was that in 2017, so that there's not a scale provided in the paper, but so the decrease in 2017 profitability for IFRS 17 compared to the previous regime was about 15 to 20%, although that did narrow kind of over the 4 years after that. And the last area from the case studies I just want to touch on was just around some of the responses around the benefits of IFRS 17. So I guess here the responses were quite mixed, really. The majority did feel that IFRS 17 could improve the quality of financial information reported. It might have been interesting to see if they replaced the word could with would, if it would have been the same. About half then felt that there would be an increased understanding of the insurance sector by capital providers and investors. So I guess that's reasonably good, not exactly spectacular. But then on the other hand, very few felt that there'd be an increased understanding of the insurance sector by other stakeholders. And so just a couple of things then to watch out for from ourselves. So in 2017, we did a global industry survey on IFRS 17. Some people here would have taken part. So we're doing a kind of revamped version, more up to date now, over the next while. So we expect that will be getting out to people probably by the end of September. So we'd encourage people to take part in that, and it'll give you an opportunity to see how you're getting on relative to market practice. We've also done lots of training courses this year, and I see loads of people who here have been on them. But we're doing another one in 2 weeks from now. So if you want to get involved, I suppose contact any of us, and we'll point you in the right direction. And we're also planning a client seminar at some point, maybe about 6 or 8 weeks from now. So we haven't locked down details of that yet, but we'll let people know as soon as we do. So then the last section then I wanted to look at was just around some of the key kind of things that we're seeing companies grapple with at the moment and expect to continue to grapple with over the next maybe 12 months or so. So on discount rates first, I guess there's sort of decisions to be made around whether to use the top-down approach or the bottom-up approach. And then if you're using the bottom-up approach, what yield curve you use, what you do after, at later durations, where there's less liquidity, how you make some allowance, if any, for liquidity on your contracts. And then, of course, tracking the discount rates over time will be important for the CSM. So it's obviously not that easy to do. On the risk adjustment, again, I don't think, there's not really at this stage sort of the industry hasn't really landed on one particular approach to use or confidence interval, or confidence level, I mean. I guess that's likely to happen over the next 12 months again. But I suppose, for European insurers, maybe the natural approach might be to use something similar to Solvency II, which are risk margin and leverage off those calculations. But even that kind of comes with its own challenges. So it might not necessarily be the right approach for everyone. And I suppose, just deciding on what confidence level to use, and then once you've decided on that level, actually coming up with a number that actually means that confidence level is also quite difficult. And as well, under IFRS 17, you need to split your risk adjustment gross and net of reinsurance, which is not something that you currently do under Solvency II. I think most people will be well aware of all of the complexities of the CSM calculation, but I suppose, deciding on grouping of policies is something that people are looking a lot at the moment. Then working through the various actuarial calculations around, the initial CSM, and then figuring out a way over time to sort of figure out which pieces of experience as it emerges flow through and are absorbed by the CSM, or which go straight to the P&L. And then the whole area of data warehousing and the storing of all the data that you need in order to do all of those calculations. And lastly, on transition then, so we're seeing a lot of companies struggle really with making either retrospective approach work. So even with the modified retrospective, the text in the standard as it currently is really quite restrictive. And that's one of the things that EFRAG have pointed out in the letter that I mentioned earlier to the IASB. That's one of the areas they focused on. So what we've seen some companies do is kind of start and try and apply the full retrospective approach, and then maybe reach a roadblock at some point, make some approximation there, and kind of move on and just keep going that way, which they feel is sort of a defendable approach. Then other companies we've seen are kind of moving straight on to just applying a fair value approach, which obviously, first of all, you need to be able to justify that it's impracticable to apply a retrospective approach. But the fair value approach even then comes with its own challenges as well. So we've seen other companies have kind of maybe done something like picked a particular point, so maybe at the start of this year or back a few years, where they'll apply the retrospective approach from this point and then use a fair value or something like that prior to that. But again, I guess you have to be able to demonstrate that it's impracticable not to apply the retrospective approach before that date. So really on these challenges and the various other ones that are there, I guess decision time is really likely to be over the next few months and into next year on all of these. So that's all I wanted to say. So I'll hand over to Lisa now. Thank you.
Good morning, everyone, and thank you to my colleagues for asking me to come speak with you this morning. So I was inspired by Eamon's survey, and I thought I would take a survey of the room myself. How many of you could definitively answer the question that, what is InsurTech? I won't call on you. Okay, I lied. No, I'm just kidding. So what I hope to do is explain to you at least Milliman's perspective of InsurTech and what we think, how it will impact the market. So I borrowed this slide from, we had the Chief Marketing Officer from TransRe come and speak to us at a forum. So I borrowed his slide, hence the dollar instead of a euro. I apologize for that. But I think this slide gives a great explanation of why InsurTech. So when you look at the business model for the insurance industry, you can see overwhelmingly 57% losses, 41% expenses. The private equity and venture capital market looks at this, and what they see is just tremendous opportunity for technology to help improve insurance. So the best way to think of InsurTech is, and a lot of people just kind of tend to think of it as disruptors, the Lemonades of the world, the ones that get a lot of promotion and hype. But the best way to look at it is to think about the fintech market, and it helps put things in perspective. So with fintech, probably over 10 to 15 years of investment into technology in the banking financial industry. So over $900 billion was spent in technology spend, in order to, in the last 10 to 15 years. 3/4 of that was actually spent on the technology. And again, as Eamon said, the other quarter was well spent on consulting to help clients either do due diligence on the technology or help them with the successful implementation of technology so that they could get the ROI that they were looking for from their investment. So why insurance now? Why is there this rush to invest in InsurTech companies? Well, there's $1 trillion worth of capital available. The venture capital folks and the private equity folks see that, and obviously there's a huge opportunity there for money to be made. This next phrase I'm always hesitant to say this. These are not my words. This is private equity words. A room of insurance people, and I'm going to tell you that it's a laggard industry. I'm sorry to be rude, but that is the way they view it. They look at a lot of old technology, so a lot of old kind of mainframes, old systems written, 10, 20, 30, 40, 50 years ago. They look at the industry as really ripe for innovation. The losses, which we just talked about, the need to update user experience, so that millennials can buy the way that they're used to buying. They can buy insurance the way they're used to buying products now. So there's just a tremendous opportunity for innovation and for return in insurance. So these numbers are up to date as of Q1 2018. Q2 numbers were not available at the time that I did this. You can see that the investment, there's been about $8.5 billion invested in insurtechs. This represents 400 companies. And again, if you use fintech as a kind of a comparison point, there was $150 billion invested into fintech companies. So when you look at where we are now, we're very early in the investment phase, so there's much more to come. There's a little bit of anomaly in 2015. I'm used to dealing with talking to the actuaries back at Milliman, so they always point out these things like the anomaly in this graph. 2015, it's not a smooth curve there. There was a huge investment in Zenefits, which makes this a little bit distorted, which was unusual at the time. So that's why you don't have kind of the nice little hockey stick. If there's one thing, this is the point where I usually say, if you're doing email or checking your phone or anything like that, this is the one thing that you want to kind of pick up and pay attention to, because I think this is the most important thing about defining insurtech. It isn't just disruptors, although they are, they do get a lot of focus, but it's really, it's three different kinds of technology trends that we see. One is enabling technology. And that's really anything that allows the company to reduce costs. So business process, big data, analytics, anything that helps you reduce the cost in your business is enabling technology. Just basically using technology to replace old systems to do things better. The next one is transformational, and that's more revenue focused instead of cost focused. Those are things like, increasing, number of customer base, increasing customer retention, attracting new market, new products, et cetera. We see a lot of AI in this category. And then there's also the disruptors, right? And those are the ones that people are more familiar with, where they're trying new business models like peer-to-peer or on demand. I get on a plane, I want to take my jewelry to Ireland, and I'm going to insure it for the duration that I'm here. So those sorts of new business model, new approaches fall in this category. This is the one that gets a lot of attention, but actually most of the spend during kind of this transformation actually occurs in the first two categories, in the enabling and in the transformational. So what problems are insurers trying to solve with insurtech? Again, not, and what is the focus of insurtech companies? Not surprisingly, a lot of it is on product and distribution because it's revenue focused. People will invest in technology that helps them increase their customer base or revenue. So right now, this is kind of getting the majority of the investment and a lot of the activity. But over the course of time, this will smooth out, again, because more of the investment will come in those two first trends, enabling and transformational. So is it just hype? So how about this survey? So how many of you think it's just hype? How many think that, this is going to come and go, it's a fad in insurance? No? Okay. Okay, either everybody's just adverse to holding up their hand this morning, or so what we see is it actually it's not just hype. We follow our clients. We picked a few of them here just to see what the difference was in how they were talking about insurtech. So we tracked their media mentions, and you can see, again, to be consistent with the other slide, I just did first quarter of 2018, not that there's been the significant drop-off, but you can again see that the volume, the activity, people are getting asked about it on their quarterly calls, their CFO, their CEO, boards. Investors want to know, what are you doing? right? They want to know that the companies that they're investing in are planning and are doing something with regard to InsurTech, because bad things happen to, historically, we look at other industries, and bad things happen to companies that, that don't pay attention to these trends. We'll get to that a little bit later. We did a survey of the market of insurers just to see what, again, our clients or what their feeling was, how they were thinking about InsurTech. And this, I have to say, so for someone who has been in technology for a long time and has, been involved in selling to insurance companies, this was astonishing to me. So 62% of those surveyed told us that they felt that InsurTech would have a major impact on their business in a year. And it's 78% told us that it would have a major impact on their business in 3 years. So I think that's pretty significant. We do see, just in talking to folks, we do see the signs of, increased technology budgets, so we see the signs pointing that this actually is going to be true, but I did find this to be pretty astonishing. So the why is that, right? So number one, obviously, they're trying to leverage the disruptors, right? The new business models. Can we do an on-demand product? Peer-to-peer, et cetera. But the second one I think is really interesting. It's the protection from disruptors. So a lot of companies are making investments because we have the benefit of looking at other industries, like, so what has Netflix done to the entertainment industry, or Amazon to retail, or Airbnb to hospitality, or Uber to the car industry, right? And this is the benefit of being a laggard, quote unquote. We have the benefit of seeing the impact that technology can have, the dominating change that technology can have to a particular industry. And I think that's why we're seeing, so early on, a lot of people really paying attention and embracing the concept of innovation in their business. So what are we doing? Like, what are insurers doing with regard to InsurTech? A number of things. So a lot of them are investing money in through VC and PE funds. A lot of them are, creating their own startup boot camps, incubators, things like that. We see Munich Re is investing, I swear, in almost everything. They're on, usually when I get asked to speak at InsurTech events, there's always someone from Munich Re, from their investment group that's there, talking about new investments that they've made. So we see a lot from just reinsurers in general, that a better way to get a view into, the products, their clients' products. So they're heavily invested in InsurTech. As I mentioned before, more companies are allocating more money to technology. So typically that was always we can't invest, we can't change, we've got regulatory issues, et cetera, it's too hard. But we're seeing now a lot of investment into new technology. One of the more interesting things that I've seen is Zurich just announced a contest. I thought this was actually very clever. So the reason that companies do this is they do it, one, obviously exits, they'll make money, but two, more importantly, for strategic purpose, right? So they want that they make an investment so they have the first right of either acquiring them or, leveraging that particular technology in their firm. So Zurich announced a contest, and they're looking for InsurTechs in very specific areas that they deem strategic to their business, and they're running this contest, and you can volunteer, submit your company, your application, et cetera, and obviously the ending result is that Zurich makes an investment, acquires, et cetera. So they have it in their strategic areas, but then they also have kind of this wild card category of surprise us, anything goes. Oops, sorry. So I thought that was actually a very clever way because it's very hard to stay kind of on top of InsurTechs, because there seems to be another one popping up every day. So I thought this was a very clever way of staying on top of it and aligning it to their strategic objectives. So in line with that, I think it's over 60% of the money that is being invested in InsurTechs actually is backed by insurers and reinsurers. So they're funding they're doing it through companies like an Aqualine, or companies are starting their own InsurTech funds where they're specifically investing in InsurTech, and they're being backed by these, buy insurers and reinsurers. And the reason is that, PE and VC folks are used to dealing with startups. Insurers are not. And so, so they manage them accordingly to success, et cetera. And it's a way of having, access to the different technologies that that may be strategic to them. So I'm going to just put all these up here on one thing. So the practical application of technology, of InsurTechs. So I'm sure most of these things, I won't ask any, I won't do I usually do a survey of blockchain to see how many people know what blockchain is, but I'm done with the survey since nobody's going to put their hand up. So what we're seeing here is, the Internet of Things, whether it's, whether it's wearables, that help you, monitor your health, which then are linked to health policies, which then link to life policies, because you've got this Fitbit that you're wearing or your Apple Watch, and you've got all these applications that are monitoring every vital organ of your body. So whether we see, Internet of Things being used for, new kinds of policies or new ways to provide value to the consumer, big data, analytics. Some of the trends that we see here are the use of, you always hear kind of like the, social media, et cetera. But we are starting to see good use of unstructured data, of social media in order to support, we see it a lot for fraud, using, Facebook information, et cetera, publicly available information to help with fraud claims. We're seeing it in cyber with regard to emerging threats. Reading kind of, what's going on with Twitter, dark web, et cetera, being able to not just understand the designated key performance indicators, but actually be able to, understand emerging threats to the business, things that are forward-looking instead of backward-looking. These things are possible because of, big data, big computing. These things would not be possible years prior. Blockchain, very simple definition. It's a database that's like hard-coded, hard time-stamped, right? Nothing changes. That's my very simple definition. Please don't ever tell a technology person that that's what it is. But it's an easy way to conceptualize it. What we're seeing here is, particularly with GDPR, the shift of the companies owning your data to the consumer actually owning their own data. Blockchain enables this. It enables the consumer to have their history, their claim history, accident history, health record, everything. It gives them the potential to actually begin to monetize, companies monetize that sort of data on behalf of the client and giving them, discounts, et cetera. Blockchain is a way actually for the consumer to monetize their own data. I think this is actually really interesting. I think we're going to see a lot of this in the years to come. And I think that insurance companies that figure out, or the InsurTechs that figure out a way to be able to, give that access to clients, where they have, that database of their consumer information, which they can use then. I think those will be really interesting changes coming up. And then lastly, the things that you're probably all familiar with, artificial intelligence, machine learning, drones, surveying land, all sorts of things. I think here, some of the interesting things, again, that we see are, for commercial vehicles, we see cameras that, you can't just like go out and buy a new commercial vehicle every day like you do a car with all the latest gadgetry that says, okay, you're swerving into a lane, I'm going to indicate to you. With commercial vehicles, we've seen, cameras that actually read your body language and your eyes and all that kind of stuff, and detect, if you're, either falling asleep or, distracted or anything, and then, tell you like that to get your attention. They'll comment, they'll do whatever in order to jar you, to wake you up. So again, I think this is, that's in that preventative category. So it's not just managing risk, it's not measuring risk. You're actually preventing, the claim from occurring. So I think, again, those kinds of technologies will be pervasive, I think, in years to come. So I've saved enough time for questions, either for myself or for the other panel here. I will say, I know that nobody likes investing in regulation. That's kind of I've got to make that investment. But But technology, the investment in technology actually that can have a tremendously positive impact. Nobody likes change, but it can have a tremendously positive impact to your business model. So hopefully that you leave here with that today.